Paul, I'll assume you're still in Montana.
Oh yeah, still here.
And like Montana, Idaho, a lot of the northern state, they're getting population boosts.
Oh man.
These last couple of years. Have you seen that in Montana?
Oh yeah, you kidding me?
Yeah.
Yeah, quite a bit. We're in 8 states now, Rich. We're from Montana down to Arizona.
Awesome.
So we're in markets that are seeing just huge in migration.
Mm-hmm.
Arizona, in particular, the Salt Lake area is just it's exploding. But even here in Billings, where I'm located, we've got just not too far from me, there's a U-Haul dealer that had to rent space in the mall across the street because they have so many U-Hauls that are one-way rentals, right? So it's a crazy time.
And how are the residents of Montana reacting to that? It's like, is there like an element of, hey, this is our little awesome slice of America that nobody knew about, and now you're all clued into it and get off our lawn?
Yeah, there's a fair amount of that. I'm not going to lie about that, Rich. And there's a fair amount of you're coming here and don't try to change everything. There's a reason why you came here. Montana is an interesting state. It used to be Montanas are very independent, very moderate, typically voting for people who they think is the best candidate for their state. And I think in the last election was really interesting because it's the only time I think in Montana history where it was 100% Republican win in every category at every level. And I think that was a statement on how Montanans in general feel about kind of where the direction of the country was going. And so, that's what I like to say in the free state of Montana. We like to be in control of our own destiny and not being told what to do.
Thanks, Paul. And sorry for the detour to our attendees, but a topic that we've touched on the show with pretty frequent regularity over the course of the last year and a half, and just population migration. And those of you just jumping on, one of our co-hosts this week, Paul Peterson from Glacier Bank Corp. I'll properly introduce him in a second. Resident of the state of Montana, which has seen a lot of population growth over the course of the last year. So, but let's get into the show. I'm Rich Swerbinsky with the Mortgage Collaborative. This is the last week in Mortgage Today, where each week I pick a couple of brilliant people from TMC's national network of hundreds of mortgage lending institution members and best-in-class third-party providers of the mortgage industry. Join me for a recap of the latest news headlines in the mortgage industry and also try to get a look inside the current business climate. And this week, pleased to be joined by a couple co-hosts. First, mentioned him briefly before, but the Senior Vice President and Director of Mortgage Banking for Glacier Bank Corp., Paul Peterson. Paul, good to see you, man.
Thanks, Rich.
And this week, also really pleased to be joined by the Chief Product Officer for our good friends and partners at Total Expert, Matt Tippett. Matt, good to see you, bud.
Yeah, good to be here. Thanks for having me.
Awesome. And before I introduce Matt, Paul, if you could start out by telling our listeners just a little bit about the Glacier Bank Corp structure, because I think it'll be good level setting for the audience. And it's a unique structure I've always found fascinating.
Sure. Thanks, Rich. So as a bank, we've grown through acquisition over the years. Glacier Bank as a Montana state chartered bank that really started back around 1980, late 70s. And over the years has grown through acquisition. Our model has been to buy really good performing banks and keep the name and keep the management teams in place. And as a result, I think we've been really successful. We just closed in October on our 17th bank division, which is Alta Bank based out of the Salt Lake City area. We have, as I mentioned, 17 bank divisions through 8 states from Montana down to Arizona. So we're covering a good section of the country that I think has done really well economically. That's obviously been to our benefit. It's a little challenging from the mortgage side because we have to, manage these different banks that, while I oversee everything for the holding company, each one of these bank divisions really has the authority to go after business in their markets as it makes sense for them and their teams, and the economies in those markets. And that's one of the reasons it's been really good, but also one of the reasons it's been challenging, particularly for mortgage, because we have one bank division that last year did 680 million, I think, down to our smallest bank division, which did about 12 million. So all in, we did about 2.5 billion across all those bank divisions. So really runs a gamut, and managing that is interesting and challenging, because we have operational people kind of dispersed throughout a good section of our footprint now. So it's fun and interesting, Rich, to be sure.
It's awesome. Congrats on the growth and success, and for laying out the structure of Glacier Bank Corp for us. And our other co-host this week, in the event you're living under a rock and don't know who Total Expert is by this point, longtime partner of the Mortgage Collaborative, really purpose-driven technology and software for the mortgage and banking industry. That's really going to be so vital for mortgage lenders as we go forward into a market that a lot more competitive for purchase business, and a market where lenders or homeowners have gobs of home equity, a topic we'll get into in a little bit. But CRM is a term I don't even like to use because you guys are really a lot more than that. But Matt Tippett, the Chief Product Officer for Total Expert, thanks for joining us, and thanks for everything that you guys have done as just an awesome partner at TMC over the years.
Yeah, it's certainly been an interesting last couple of years, and the whiplash that we're all experiencing right now, we just want to be here to help lenders figure it out. It's certainly going to be an interesting year ahead, coming off of a couple of crazy years. And the CRM term, for sure, we sometimes refer to ourselves as a customer experience platform, because we're both helping the salespeople and we're helping the marketers, trying to unify that customer experience for every potential borrower. But yeah, good to have this partnership, and good to be on today.
And you came over, you had a pretty senior position at Salesforce. And if I remember correctly, you came over to Total Expert. It was like not long after the pandemic, like welcome to the mortgage industry.
Yeah, it was. I was at Salesforce for about 8 years, and I did want to get into something. You mentioned purpose built when you were introducing me. I wanted to get into something that was a little more oriented toward financial services. Was certainly one of my more prominent options, and it was the summer of 2020. So I'm just over a year and a half in, and definitely interesting time into the deep end, and helping these folks out as much as we can.
All right, excellent. Well, let's get into it. As always, no shortage of topics and news to cover. And as always, encourage questions, comments, interaction from our live audience. Go ahead and drop that in the chat or the Q&A if you have any questions for any of us, and we'll incorporate it into the show. Per usual, the top story right now, just interest rates. Another spike that we saw here over the course of the last few days, fueled by a lot of things going on in the world. And the Federal Reserve meeting as we speak right now will conclude their latest meeting tomorrow with what everybody is anticipating will be the first hike in interest rates in a long time, most likely 25 basis points. But just more broadly, if you look at the interest rate climate since March 1st, the 10-year Treasury yield has gone up 45 basis points, bringing 30-year fixed rates up about 0.5% with it. You go back to early December, 10-year up over 80 basis points in yield. So a lot of rate shock. Historically, interest rates, not astronomical by any means, but certainly a departure from where we've been the last few years. So Paul, I'll start with you just from the lender side of things, just kind of your assessment of the current business climate right now as we get into the spring buying season.
Rich, I think yesterday I read where Rocket Mortgage had announced that I think fourth quarter, their margins were down from 440 down to 280. Their volume was down 29%. I think that's the state of the industry today. I think that's a pretty good example of where we are. You throw in there the volatility that you're talking about. Rates have obviously been moving a lot just in the last 2 days, as you mentioned, even today. Although even within the day, we saw some improvement in the morning, and now it's kind of given up a lot of that. I think we're in this place right now where we have everyone fighting for less volume, right? And everyone giving up margin to try to bring in that volume. And I think recruiting within the industry right now is super intense. We're losing people. We're getting people. That's the nature of it. I know of a bank that was a pretty decent sized mortgage originator that reorganized their head of mortgage out of a job, let him go. I would imagine that once the rest of the organization realizes what's going on, that they're going to be out of the business here probably within the year. Unfortunately, a lot of those mortgage people probably don't realize that yet, but I think it's happening. And I think a lot of this is driven by these just hugely volatile times that we're in. And, I'm a believer as far as inflation goes that I think they're continuing to miss the mark. We had a 10% wholesale inflation come out this morning, which was the highest on record. Now, granted, they've only been keeping track of that for a little over 10 years. But they were, watching the market news, they were kind of celebrating because the month over month was better than the estimates. So still really bad. I think it's going to get worse. I think that's going to cause, continued volatility in the rates. And, I think, we got to all buckle in and be ready for this. And I think a key for this year, certainly for us, but I think for most lenders is how do you, continue to recruit and retain good MLOs. Everybody has an operations machine that they have to feed. And in this kind of market, you and I have been around this business for a while. What we see typically is, the recruiters are going after our people, particularly our good ones. We need to do what we can to retain them. And we also need to be looking at how can we bring on people because there's this dislocation happening like this bank that I mentioned. If you're running across that in your markets, it's an opportunity because those people will be out looking for jobs.
Yeah, absolutely. It's a crazy climate right now. The movement of people, I mean, just being on LinkedIn and people we know that have made moves and acquisitions, it is at a pace and a fury that I haven't seen in a long time, especially just LO recruiting, because most lenders are sitting on chassis that can handle a lot more volume. Most of them made a fair amount of money the last couple of years. You ball that all up. And on the flip side, Paul, you made a good point. Like everybody's coming after their people too. So it's not only I need to add to the coffers and add to the production bucket, but you almost got to anticipate some people are going to leave in this type of climate. So you're trying to replace what's likely to leave out the door. And then also to continue to grow your business. Unique climate right now.
Yeah, very much so. Very much so.
And Matt, from your side of the world, I mean, your system obviously had a lot of value to our member clients the last couple of years in just identifying refinance opportunities and getting to those customers quick before the rest of the world who was looking to do the same did. But now this is where like you guys really earn your money as a marketing operating system. All the tools, all the features that, the LOs that Paul's recruiting and people are of recruiting of his, a need to stay in front of all their top referral sources. And, a lot of bad news in the news right now for the mortgage industry, if it's rates or inventory or values are just making home ownership unattainable for a lot. But one of the good sides of the ledger is just the ridiculous amount of equity that homeowners have right now. I mean, the numbers are staggering. $3.2 trillion in equity homeowners gained in 2021. The average annual gain in equity for the average American home buyer last year was a $55,000 gain in equity. So a lot there to be tapped for people to, if it's deal with the rough times or improve the home they live in, but interest rate climate, somewhat of an impediment to that. With all that, would just kind of turn to you to get your thoughts on the current business climate right now from your side of the world.
Yes. So one quick diversion, which is this comment that Paul makes about recruiting and turnover. That's also true of the technology industry. I think in general, it's a really turbulent employment time. And Paul mentioned earlier about the migration to Montana and other states. There's a lot of technology people moving around and changing dynamics in markets right now. You see it in the Denver market and the Austin market. A lot of interesting things driven by these technology folks. So that said, certainly one of the things that has changed dramatically is that I no longer have a lead funnel that I can take for granted. And the refis are just going to pour in, and I'll get to the ones that I get to because I know I'm going to close enough business this year. Which means that there's now an opportunity to demonstrate white glove service, and this is an important part of what we're encouraging our customers to do. There's no longer the option to let leads fall through, right? When the last couple of years, it's okay because everybody's the rising tide raised all the boats, and every boat was happy with the fish that they were catching. But now you can't let those leads drop through. So how do we give every single person white glove service? You mentioned marketing operating system, reaching out to people with really good content that's also compliant. Doing that from the moment we understand someone has a particular interest. White glove service is a key theme. I also think education is an opportunity. This ties into, going to talk a little bit more about equity momentarily, but all of these homeowners that you referenced didn't have to do anything to see this equity increase, which means it's invisible value in many cases. And here we have folks dealing with, there's serious inflation issues now, and it really is making an impact on homeowners' budgets and renters' budgets. It's making a difference. So if lenders can have this opportunity now to educate, and it really should not be focused on what lenders need. It should really be focused on education of the consumer and how equity can help them. They might have revolving credit debt and other instruments that are just even higher interest rate as we talk about these incremental changes in the 30-year rate. So education is critical. And then on equity, the question is, how do we seek to understand the data around homeowners, particularly those who have borrowed it from us before? And how do we generate those insights? How do we surface those insights in front of loan officers so that they can proactively educate and help consumers make good decisions with that equity they've built up? So equity is definitely an opportunity, but that white glove service and the education, I think, are necessary to stand apart this year.
Another topic that really central to what's going on with housing, Paul, just the home builder climate and construction of new homes, a wagging tail to the inventory issue, and that builders are building very cautiously, very slowly, a lot of impediments. And some news that broke today, the White House hosted an event, I guess bringing in business leaders from across America and some key areas of the economy, and National Association of Home Builders Chairman Jerry Conter made a pretty loud plea to the White House. Two things. One, increased timber production on federal lands. It's decreased for many decades in a row, and we are dying, and the housing industry in America is dying without enough lumber. And two, strike a new deal with Canada, a new lumber deal that is tariff-free that could benefit both countries. Not sure that just came out, but maybe your thoughts more on the broader home builder issue. You haven't worked for depositories for a long time throughout your career.
Yeah, well, it's interesting, Rich, because I happened to be talking to a friend of mine this morning who's in the home building construction area, and it kind of relates to inflation too, and kind of part of why my stance on that is we're way undershooting that. He and I were talking about cost of materials and his projects that he's got going on and whatnot. He relayed to me that in the last year, just for example, his cost of siding has gone up 60%. 60%. So when you think about a builder out there, they're not seeing 10% inflation, right? They're just not seeing that. They're seeing 60%, and it's hard to get the material. So I think that's something that's going to be with us for a while, and what the long-term impact of that is to be determined. But it's certainly, it's going to have an effect on the housing stock that's available, how fast they can, build homes and bring them to market. I think it continues to have affordability issues. I don't know what the outcome is here, Rich. We've never been here before. I can tell you that if you go back and look up articles back kind of pre-Great Recession, and there were plenty of articles that said, well, this is different. It's going to keep going. It's going to keep going. So, and you can look at recent articles and it's the same thing, right? This is going to keep going. And it's really interesting to see when you read those articles, how similar they are. We've been around this business for a while. Something's going to happen. Something's going to change. There has to be an adjustment. There's just too much dislocation happening today. It just can't continue.
Home values up almost 30% nationally the last 2 years. The path that we're on already here in 2022 is to go up another 15 to 18% if things continue at the current clip. Now, historically, home prices have gone up between about 3% a year on average. If you look at the history of home appreciation. And Matt, you're looking for good news once again. We talked about all the equity that homeowners have. Another is, and I guess this is a bad news for people that are renting, but good news for the purchase market, in that buying a home is still a far better deal for the vast majority of Americans than renting. Rents continue to go up. All the institutional ownership of investment properties in America, CoreLogic's latest numbers this morning, rents up 12.6% year over year, keep going up. Several economists cited in the column, all projecting rents to continue to rise at least until the third quarter. You got some states in America that are considering rent control legislation to, put a clamp on just housing inflation issues that are plaguing their constituency. Your thoughts on some of the positive items that I mentioned that we can look forward to hopefully here in 22.
I think we've already seen the pivot to the purchase market, and what you were just articulating is that there's more incentive to purchase. I mean, rates are not. I actually was just looking back in time a little bit to when my parents bought the house that I grew up in, which was at the peak. It was 83, 84. It was in there, and so their rates were 13, 14% at best. So our rates right now, even though they're rising and it is making a dent in the industry, are not that high. So to your point, there is incentive to move into purchase for those who are renting. And certainly there's incentive also to use that equity to up level. If you had a kid or two, you got more pets, whatever that case is. So there's definitely an opportunity to invest in that purchase market as lenders. And another trend that comes out of this is back to the basics. So there was not a lot of energy, I would say, around real estate partnerships and my co-marketing efforts. But if we're moving to the purchase market, there's an opportunity to go either reinvigorate or recreate, reestablish some of those relationships about getting back to the basics and get together with people whose feet are on the ground and make sure that those relationships are strong and that you're supporting them just like they're supporting you. And you're out there in the market to ensure that every buyer has you as an option, right? Every buyer possible has you as an option. So I think the good news is that the purchase market is, even with rising prices, the purchase market is definitely an option. And the question is, how do we capitalize on that with things like more traditional basics about how we've approached the market previously? And then coming back to this equity question, it would just be a recommendation not to wait until your existing borrowers, your existing customers, if you're a bank, are reaching out to you, suggesting what they might do with a home equity line of credit or what they might do to up-level their home. But instead, you're providing that education and service because you're keeping a track of how much equity they may have in their home, and you're being proactive about those opportunities. So yes, it's a pivot to purchase. Yes, it requires more work, but with the right, obviously I'm a technology guy, with the right technology, we can help ease and streamline some of that work. And then the data and making sure you have insights about every one of your customers, every one of your existing borrowers that you've loaned to in the past, having that data to understand where their equity might be sitting, or even where their rate might be sitting in the instance where they can actually benefit from some of the rate changes that are going on, and being proactive about that. So there is good news, there is opportunity, but we have to go get it. It's not coming to us.
Yeah, Guy, just the data that is available to mortgage lenders on their portfolio, their books of past business, even when I ceased being a lender about 7 years ago and took this job, it's staggering the difference in the how long away the mortgage industry's come in terms of being able to capitalize on past business and not having customers walk away. We've talked to some members of ours that have been selling servicing like before, been selling servicing recently because of the great multiples they're getting. And that's basically their point of view. Like, we have such great tech. We're not as worried about selling servicing anymore because we have tools and technology that allow us to retain those borrowers without the servicing. So great points, Matt. This is the last week in mortgage today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by Glacier Bank Corp's Senior Vice President, Director of Mortgage Banking, Paul Peterson, and Total Experts Chief Product Officer, Matt Tippett. Got about 5 minutes left with the fellas. And Paul, I think you could kind of see the tea leaves starting to unfold for housing becoming really a top issue for a lot of Americans as it relates to just voting and national issues, which says a lot given everything going on in the world right now. You're starting to see the politicians start to figure this out after, I would say, largely ignoring to some degree a lot of the issues that are now plaguing housing bubble up. Republicans are, really starting to circle around the home builder issue, all the impediments to home builders, if it's labor, lumber, land, costs, and to make building homes under 400,000 or 500,000 most parts of America non-profitable for them. Democrats are starting to talk about ways to those borrowers on the margin and ways to put people in home and alternative credit modeling and other ways to help get low to moderate income and minority borrowers into homes that are being left out now. Your thoughts on housing becoming a pretty major national issue as we get into the midterm elections?
First of all, I don't think that politicians usually don't help when they get involved. They usually make it worse. I think the best thing they could do would be to, get out of our way and let us help people. I would say that the majority of people in this business are here to help other people. And in the case of home buying, help people break down those hurdles and get into homes. And I think politicians have a way of just kind of screwing everything up, and the more they can stay out of it, the better. So it actually makes me a little nervous when I hear politicians starting to take focus on it and throw things at it. I mean, when I started in this business, Rich, which was, probably quite a long time ahead of you, there was a housing ratio and a debt ratio, right? And it was 28-36. That was how you qualified people. Now we're at a total debt ratio of 43% generally, kind of what we go to. We'll go over that, right? Well, how successful are we being when we put someone in a home that's over 50% debt ratio, right? Particularly in these times. I look at this and go, a politician is likely to go in and push the debt ratio up to 50% or something, not understanding the impact to that customer, 2 years down the road when inflation is crushing them and they have to make their mortgage payments. So it makes me a little nervous when the government starts getting involved in this. That's just kind of my take on it. I don't know how you or Matt feel about that.
Listen,
I'm particularly curious to see if we move right from quantitative easing to quantitative tightening, just like immediately. Speaking of the whiplash that we've seen.
And our friend is Rob Krisman is in the chat saying, one, let's not forget Ivy's element, thoroughly believing the housing stock is imbalanced too much on the side of supply. That looks a little questionable right now. And that he agrees 100% with Paul's view of politicians interfering in the free market and risk, and something Rob and I talk about our Friday show. One easy historical graph to look at that has always been right is when the home ownership rate in America gets above, I think it's like, 72, 73%, all hell breaks loose. That there is a certain percentage of Americans that are meant to own homes. And when things happen to cause it to go above that, it creates issues, quite frankly, larger than the ones we're dealing with today. So very valid points there, Paul. But it is going to be very interesting to see. I think the Republicans are largely saying, just get out of the home builders' way, let them build homes and let market forces be at play. And then you got the Democrats, Biden administration that have been very vocal on housing. Not a lot has been done But, I think everything they're trying to achieve is going quickly away from them. So it's going to be very interesting with the president's poll numbers not being great, how they use housing policy to maybe correct some of that. So, Matt, take us home. Just any other thoughts on the year ahead of us, trends you're seeing? You have the luxury of working with a lot of lender clients all across America, typically tech forward lenders that are employing software and technology like Total Expert. So just be interested in your perspective on the market as we get into the spring buying season to close us out here.
And I think I will tilt a little bit more technology in the last answer. We've talked some about data and insights. You've really got to focus on pulling all of that data together, both data that you own and data that's available in the marketplace. A vendor like Total Expert, certainly, we're focused on doing that. We also need to ensure that MLOs are well supported with the technology that they have. Are they going across 3, 4, 5 different systems to get their job done, or are they unified in one place? And so are the tools that you're providing to loan officers adopted? And if they're not adopted, how can we provide them things that they will use? Automation is a big deal. I talked about white glove service earlier. Yes, we want to trust our people. Our people are involved. Our people are going to close those loans. But if we have automation supporting them, that's going to ensure we have fewer potential borrowers falling through the cracks. So if we can centralize our data, centralize our technology, if we can provide tools that loan officers will use and will help them be more productive, and if we can apply automation, we're more likely to break through this year and be successful even in a tighter market. So just some closing thoughts there from more of a technology point of view versus some of the other conversation, which I've definitely appreciated. It's been a good chat.
Very well put, man. Yeah, I would agree. Very compelling conversation. Greatly appreciate you both taking some time out. Certainly fascinating time for our industry and housing right now, and a lot to keep tabs on as we cascade throughout 2022. So Paul, good to see you, man. Been a while, and hopefully we can throw down a cold carbonated beverage one day in the next year, hopefully.
Sounds good.
Awesome. And Matt, as always, good to see you. Appreciate the partnership with Total Expert, and thanks for joining us today.
Yeah, thanks, Rich. Appreciate it, everybody.
And to our attendees, thanks as always for taking 30 minutes out with us. We're here every Tuesday at 2 p.m. Eastern with the Last Week in Mortgage Today. Until next Tuesday, have a great rest of the week, everyone. Take care.
Thank you.